You've made your selection. You've chosen your new EV, right down to the colour, the model and all the optional extras. Now comes the dreaded moment. How are you going to pay for it? There are numerous options. Each has advantages and probably also disadvantages. I'm Dave and I am taking on EV car financing. For many people, there's simply no choice. You might always use cash or lease, and every time you change your car, you use the same method. And there's nothing wrong with this, but sometimes it is a good idea to just stop and look at the alternatives before making a major decision like this. Some of the options might offer a significant saving. I'm going to cover one of those later. Very interesting. Cash is probably the easiest one. You either have the money, full amount in your bank account waiting for you, or you don't. The main advantage of using cash is that you own the car instantly. It's yours. You hand over your cash, you get your car. From a financial point of view, you lose the interest that the cash would have earned while in your savings account, but you gain from the fact that you do not have to pay any interest when you're buying the car. If the cash is genuinely spare cash, the interest you lose will almost always be less than the interest that you would be paying on any form of financing. So cash really is the simplest of all the options. So if you do have spare money, could well be your best option. Now, when we talk about loans, many people confuse a loan with hire purchase. The two are very different. In essence, a loan is made to you, the person, from a finance company, probably a bank. It can be used to buy whatever you want. And if for any reason you are in future unable to make the repayments, the finance company will want to talk to you to recover their money. Whatever you have bought with their money now belongs to you. So at the very cheapest end of the finance market, there are the interest-free loans. Put very simply, you borrow £1,000, you pay back £1,000. Now, obviously, the banks do not lend money without interest. So in the car world, it would be the dealer or the manufacturer who absorbs the interest to be able to offer you an interest-free loan. You pay back the loan, the dealer, behind the scenes, pays the interest for you. Well, these have one huge advantage in that you would be able to keep your savings intact, earning you interest, and use the money from your savings account to pay the monthly repayments. So in effect, you make a small amount of money in interest on the capital while it's in your savings account while you're buying your vehicle. There's no real downside, so interest-free loans should be your first option. Most loans, however, do incur interest. And the rate of interest can make a very significant difference to the overall cost of the vehicle. The interest rate often does vary depending on where you borrow the money from. Assuming the dealer's not subsidising the EV loan in any way, it's often cheaper to go direct to your bank. They'll have all the details of your credit history. If you've got a good credit score, that can result in a lower interest rate. The dealer will almost certainly have their own finance company with whom they work, and they will make you their offer. Now, while you'll still have to complete a finance agreement, where the finance company will again look at your credit score and credit history, these will generally be at a higher rate of interest. By law, the banks and the dealers must disclose the amount of the loan, the interest rate, the APR, and the total cost of credit and the period of time it runs over. And it is really the total cost of credit that's the key figure. And in all financial dealings, there will be a legal cooling off period, normally 14 days. During this, it can just be cancelled with absolutely no cost or charge whatsoever. But the important thing here is the less interest you can pay, the better this will be for you. Whereas the more interest you can be persuaded to pay, the better the deal will be for the dealer. You should be concerned about what you're paying or saving, not the dealer. They can look after themselves. As opposed to a loan, there's hire purchase, and this differs from the loan in that the finance company will lend you the money and use whatever you are buying as security. The finance company will therefore legally own your EV and will retain legal ownership until you have made the final repayment. In effect, you're hiring the vehicle from the finance company. On completion of the loan agreement and making the final payment, the EV finally legally belongs to you. However, during the term of the hire purchase agreement, Most people will treat the EV as if they already owned it. You're generally free to make modifications, changes, respray it, do whatever you want to, as if you owned it. But overall, be aware that the finance company will not take kindly to you doing anything that in any way devalues the car that they legally own. That would mean they may not recover their money if you default. So in simple terms, if you do make all the payments, there's very little difference between a loan and a hire purchase agreement, just a legal technicality. It's really only when somebody cannot complete the agreement where the difference between a loan and a hire purchase agreement will become very obvious. Now, when we move on to leases, many people believe a lease is a lease, but there are many different types of lease. In essence, at least, a lease is just simply rental agreement. The leasing company will buy the vehicle from the manufacturer or dealer, and they will own that vehicle. They will arrange a monthly premium for you to pay that will take into account how long you want the vehicle for, how many miles you'll be driving during the time the vehicle is leased to you. And the premium normally will be the purchase price of the vehicle minus whatever that vehicle is likely to be worth at the end of the lease agreement, plus costs, plus interest charges, obviously. It's not a charity. So in actual figures, if you buy a £40,000 car and lease it for 3 years, and with the mileage that you've agreed, the car will be worth £20,000 in 3 years' time, the leasing company will take that cost, the £20,000, add their interest and charges, and then divide by 36 payments for 3 years. In effect, you're simply paying for the depreciation of the vehicle. However, leases do differ, and particularly in the interest rate charged. And there are lease deals with 0% interest. Tesla at the moment on the Model 3 offers a leasing deal with 0% interest. And once again, it will normally be the dealer or the manufacturer who will cover the interest charges incurred by the leasing company. Well, the simplest form of a lease is called a PCH, which is a personal contract hire. Hire, you see, you don't own it. As described above, you'll never own the car. You will never have an option to buy the car at any time. You may or may not be asked to pay a deposit, and the monthly payments will generally be lower than other types of leases. Provided the terms of the lease agreement have been complied with, and the only two real concern here are the condition of the car and the mileage, then you simply hand the car back at the end of the lease agreement. That's it. Whatever the car is worth is nothing whatsoever to do with you. You pick up your new car, you make your payments, and in good condition, you hand it back. If the car market has crashed and your car is almost worthless, it's not your problem. You just hand it back. It was the leasing company's problem. Similarly, if the car market has boomed and the car is now worth a fortune, more than the agreement originally estimated, then the leasing company is the one that benefit from that, not you. The two conditions, let's start with mileage. The final value of your leased car will be dependent on how many miles you've covered. So at the beginning of every agreement, you will, with the leasing company, specify how many miles you're allowed to do each year. If you do not do this many miles, then the car will be worth more at the end, but you cannot gain from it. There's no advantage to driving fewer miles. If at the end of the agreement you have exceeded the stated number of miles, there will be a specified charge per mile because the car will be worth less than the finance company anticipated. Regarding condition, no car can be in perfect condition at the end of a 3-year lease. Leasing companies do not expect this, so minor damage such as stone chips, very light scratches, paint fading, carpet wear or seat wear, a few scratches on the dashboard, these will be taken as fair wear and tear, and they will not affect you handing the car back at the end of the agreement. However, if there is significant damage, either inside or outside, then the leasing company will either require that damage to be corrected before you hand it back, or they will charge you to correct it once you hand the car back and charge you for it. In that case, when you hand the car back, you will subsequently be given a bill for whatever it costs to correct the damage. Often included in a PCH is the offer of a maintenance agreement. The leasing company will calculate the total cost of maintenance over the term of the lease, divide that by the number of repayments, in this case 36 months. So you pay Small amount each month, but whenever the car needs servicing, you simply hand it back to the garage, servicing will be done, and the leasing company will pick up that bill. Maintenance options simply mean that the total cost of keeping that car for the duration of the lease is now pretty much fixed, and will normally cover things like tyres. Well, apart from insurance and charging the car, whatever the lease monthly premium is, that's the total you'll pay each month for the next 36 months on a 3-year lease. Private leases. PCP stands for Personal Contract Plan. And this is different in one way specifically. You'll agree the same length of the lease and the miles covered, that's no different. But at the end of the lease, you're going to be faced with a choice. You'll have hired it, in this case for 36 months, but instead of just handing it back, you will normally have 4 choices. The first one is just hand it back. Right? So in that way, it is exactly like PCH. If you don't want it, if you've had your time with it and you don't need it anymore, just hand it back. The second option will be to make a final one-off payment, often called a balloon payment, which will have been agreed at the beginning of the lease, and on paying that amount, you then buy and only illegally own the car. You do not hand it back, it becomes your car. Well, obviously, you've got an advantage here, because if the car during the 3 years you have it absolutely crashes in terms of value with high depreciation, there'd be no benefit to buying it back at a higher price you agreed 3 years previously. Hand it back. On the other hand, if at the end of the lease the balloon payment is significantly lower than what the car is actually selling for in the dealerships, buy it, because you might get yourself a bargain. If you want the car and can afford it, pay the final amount, then you own the EV. The third option is to use whatever equity, if any, you have in that car as a part exchange deposit for your next leased car. You hand the car back at the end of the lease to the dealer, who then sells the car. And if that's what he gets is more than the outstanding amount that was agreed, you can use that difference towards a deposit towards a new lease. Well, the fourth option is to keep the car and refinance the outstanding balance, where that finance could be a hire purchase agreement, a loan, or even another lease. Well, PCP will often be at a slightly higher interest rate, but the options at the end might suit your needs very much better. It also offers flexible options during the lease, where changing cars mid-lease becomes possible. The agreement can always be paid off. Look at company cars. Yeah, it's company cars, essentially a gift from your company to you of a new car, paid for by them, to be better able to carry out your task or to make your job more attractive. In the case of a rep, a company car is almost essential, because without one, the rep may not be able to afford a decent car and might turn up at a customer's premises in an old banger. That might not be the right image for the company. Now, there's normally very little you can do to influence the company. Generally speaking, they'll either voluntarily offer you a company car or never. However, it does no harm to ask. While the company may give you the car for free, it's obviously not a gift, nor is it actually free. The company will at all times own that car and merely allow you the use of it. It will never be yours. The value of that car will normally be allowed for in your salary. You get a lower salary if you're getting a free car. Free. So there's no such thing as a free lunch. But in addition, the taxman will be very keen to get a fair share of this free gift. The taxman will quite simply calculate how much the car is worth and then make a charge for that against your tax code based on that value. You will pay more tax than if you didn't have a company car. However, the government has decided that the taxman cannot take too much of that benefit away from you. And so the additional amount of tax that the taxman will take is dramatically reduced with an EV, as opposed to a petrol or diesel car. This is simply to encourage company car drivers to choose an EV over a petrol or diesel car. Fits in with government policy. It will be very much cheaper. Now, once again, when I had a company car and it came time to change, I would often be offered the option of buying that car at a set figure. So in my case, because at the time I was staying with the same company and I was being offered a brand new car, had no advantage for me. But the option was there, and it is with some companies. Now, when it comes to salary sacrifice leasing, the final option. If you go to your boss and ask for a company car, they can say no, and that's it. And previously, your only option then would have been to buy your own car or take out a private lease and use your own car. But salary sacrifice is now taking over as the most preferred method of financing any new car. If you actually bought for a company car, there are financial reasons why this might not be possible. The salary sacrifice scheme might be an answer to that problem. See, these work very simply. You choose to lease a car, but the monthly premium for that lease is taken directly from your salary. Unlike company cars, this scheme is available to all employees. And the main reason this is so popular is that the monthly car payments are deducted from your pre-tax salary as opposed to paying the monthly premium out of your taxed salary. That's what's left after you've paid tax and national insurance contributions. In effect, you're saving the tax liable and the national insurance liable on the value of the car as a benefit to you, or benefit in kind as the taxman calls it. And it means that the monthly premium is significantly lower for all taxpayers for EVs, but especially for higher taxpayers. To make it even easier, salary sacrifice leases usually include the cost of insurance, servicing, maintenance, breakdown cover, and might even include tyres and wiper blades. This now really is a single premium that covers all of your motoring for a brand new car for the duration of the lease. And the reason you're seeing so many electric vehicles on the road is that the benefit in kind, the amount of tax that you would normally pay, is significantly lower with an EV than with a petrol or diesel car. It's double whammy. It is genuinely a scheme whereby the employer and the employee both benefit. The one who loses out is the UK taxman, but the government has already agreed to that, so he can't complain. For the employer, they simply contact a salary sacrifice leasing company, and there are plenty of them about. And that company does everything. The employer has to do nothing other than to say, go ahead. The employer nods his head. There's no cost, no work involved. However, offering a brand new EV to all of their employees, taxed, insured, service, maintenance, everything, is a great way of retaining staff who otherwise might leave seeking better pay elsewhere. You're going to think twice about leaving if you have to hand your car back. So the employer benefits from staff retention, staff happiness. Well, for the employee, they suddenly find they're being offered a brand new EV of their choice, which includes, well, absolutely everything. Insurance, servicing, maintenance, tyres, windscreen wipers. There's nothing for the employee to pay apart from the premium. And the premium they pay is very much less than they would be forced to pay if they had to lease privately. It really is the simplest form of motoring, and many salary sacrifice companies will go further and offer you, for example, a home charger supplied fully installed free of charge. And often they'll offer you a credit, financial credit towards your first few thousand miles of motoring. It's no wonder that EVs are becoming very popular. Over a quarter of all new car sales are now EVs, and the majority of those will be financed via a salary sacrifice lease. Well, there are so many cars, so many prices, so many offers, so many variables, it's impossible to give a single figure that will show you the advantage of a salary sacrifice lease. However, as a guide, let's have a look. If you're a basic rate taxpayer and you're looking at a smallish car, let's have a look. So 20% taxpayer and you choose a car like the MG4. Then you would save about £100 a month by choosing an EV, as opposed to a petrol equivalent, maybe a Renault Clio. Now, if you're a 40% taxpayer, that saving would stretch to over £145 a month. That's £1,750 a year saving by choosing the EV on a salary sacrifice over a petrol or diesel car, also on a salary sacrifice. Now, instead of making a financial saving, many employers are realising you can take advantage of the fact that they can get a very much more expensive car using salary sacrifice than they would normally be able to afford. And hence, you'll see many of the more expensive cars are on salary sacrifice lists. For example, obviously the Porsche Taycan and Lotus Electra appearing regularly. Take an example, the Lotus Electra on the salary sacrifice scheme. As a 45% taxpayer over a petrol Porsche Macan, you'd save about £670 per month. Per month. It's an amazing difference for a cracking car. Should also be of interest to know that you can now salary sacrifice used EVs for even greater savings. These will be previously leased cars having completed their 1, 2 or 3 year lease agreements, and they're actually in tip-top condition. Well, the final decider is that for most salary sacrifice schemes, there is no deposit up front at all for the employee to pay. You literally say, yes, I'll have one. You get your brand new car. At the end of the month, you start making your monthly payments, which comes straight out your salary. Well, because the salary sacrifice lease is actually taken out by the employer, the question of what happens if you leave the company always arises. Most salary sacrifice agreements will include an early termination agreement. It'll be written into the deal, and an early termination fee, depending what early termination protection your employer has. Now, circumstances can change, so protection is built in to protect you, the employee, but in many cases, it is entirely at the discretion of your employer. And if your employer, for example, when you leave is taking someone on to replace you, they may simply take your EV back and hand it over to them, in which case you would incur no fees or charges whatsoever. If you're in a nice stable career and changing jobs or being made redundant are not issues for you, you do still have the protection, but it may not need to be a major worry. If you're thinking of changing your job, check out the terms that are offered, that are always agreed in advance within the salary sacrifice agreement. Well, in summary, I hope this has been a great help to you. I'm sorry it's a longer video than normal, but it's a very complicated subject. Choosing the wrong finance package can cost you a significant amount of money in interest charges or earlier cancellation fees if circumstances dictate. This video is not intended to tell you which is the best for you, but merely to give you all the options so that you can choose whichever one suits you best. We'll be updating our previously released video on which will be the best for most people in the near future, where we look at what are the advantages and disadvantages of each. So if you want to see that one, please subscribe to the channel, click the notification bell. And if you have enjoyed the video, please click the like button. It makes such a difference on the YouTube algorithm to the channel. Thanks for watching. I'm Dave.